Hello and welcome back to followers of the Kaspa journey. Today we're going to be getting into the game theory of Kaspa. There's an extremely famous quote by Charlie Munger which goes, "Show me the incentives and I will show you the outcome." And what this means is that if you know the incentives and the game theory of a system, you can take an educated guess at what the outcome of these incentives and system is going to be. And so again, to really truly get into the game theory of Kaspa, we are first going to have a look at the game theory and incentives of fiat and Bitcoin. So before we get into it today, guys, don't forget to like and subscribe. And also don't forget to check out the Patreon if you are interested in 12 unique Kaspa trading indicators, as well as a private trading community. So what is game theory? Game theory is the study of how and why individuals, aka players, make decisions about their situations. So basically, it is a social science of attempting to predict the outcomes of any game or situation based on what the optimal decision making of the players within the game would be. So for a game, you need to have number one, rational actors, so players who have specific goals and act in order to achieve them, and also assuming that these players or actors act within their own self-interest. 2 is a set of finite and well-defined actions that players can make. 3 is a set of finite and well-defined possible counter-moves to those actions. And number 4 is both a winner and a loser and some sort of payoff and some sort of consequence. So one of the most famous examples of game theory is something called the prisoner's dilemma. And in this scenario, there are two prisoners, prisoner A and prisoner B. And they are in a situation where if both prisoners remain silent, they will have 1 year in jail each. If both prisoners confess, then they will have 5 years in jail each. If one of them remains silent and one of them confesses, the one who confesses will walk free and the one who remains silent will have 20 years in jail. And so to understand this, we are going to put ourselves in the shoes of prisoner A. So we either have two options. We can either confess or we can remain silent. So if prisoner B is choosing to remain silent, then we can actually gain an advantage by confessing and getting 0 years in jail rather than 1 year by remaining silent. And if prisoner B is choosing to confess, then we can also gain an advantage by confessing. So we will have 5 years in jail rather than 20 years. And therefore, individually, the optimal route is always to confess because there is always an advantage to be gained by confessing. Even though overall collectively, that is the worst outcome, and the best outcome would be to both remain silent and both have 1 year in jail each. However, that collective route of 1 year each requires trust in the situation. Now there's something called Nash's equilibrium. Nash's equilibrium is when the game reaches an optimal outcome, and this is the scenario where no player stands to gain an advantage anymore. This is the most optimal scenario for each player. So in this case, both prisoners confessing is Nash's equilibrium because that is the most optimal scenario individually for each player. And keep Nash's equilibrium in mind because it's very important, and Nash's equilibrium basically is a very good predictor of how the world and how a system is going to end up, because that is the optimal outcome for the highest number of players. And so now we're going to have a look at the game theory and incentives of fiat. Now fiat has perverse incentives because in a democracy, politicians are elected based on their promises to the public. So what is the situation which is more likely to be elected? The politician who is promising we are going to balance the books, reduce debt and be fiscally responsible, but prepare for hard times. And all those social programs that have been funded, they are no longer going to be funded. Or the politician who says we're going to keep the good times going, we are going to grow the economy and we are going to make your lives easier, but we are going to do that using debt. Every single time, politician number 2 will be elected. And so the incentives and the game theory of fiat are to increase the levels of debt in the system, which inevitably leads to debasement. This also works on a geopolitical scale. Governments are incentivized to print to be able to compete on the global stage, because if one government starts printing and putting that money towards a military budget, then all of the other governments are also incentivized to do that, to try and compete and to try and keep up. And so again, the game theory of governments on that global stage is to use the currency and to print money to give themselves a better position on the global stage. And it's the exact same for fiat users. Fiat users are incentivized to borrow as much money as possible. You know, anyone who has done well in the past 4 decades, who hasn't bought a business and has just worked a normal job, has done well really for one reason. They shorted fiat and they took out a large loan to buy scarce goods. You know, a lot of people talk about how their home purchase was their best investment, and that has yielded extremely high returns over the past 40 years or so, but you would have actually been better 40 years ago to take out a loan and put that money into the stock market and then rent instead. You would actually be better off now than if you had bought a home. So it's not the home that has done well, it's the shorting of fiat and taking out a huge amount of debt which has made people do well. And so we can see the Nash equilibrium of fiat is to borrow and debase. The most optimal thing you can do within a fiat system is to try and get ahead of the currency debasement. Basically, it is a race to the bottom because all of the incentives of fiat line up towards the currency being debased. So there was a TV program called Golden Balls which ran in the late 90s and 2000s in the UK and is one of the best examples of game theory in real life. So there were 2 contestants who would be competing towards a pool of money, and the contestants had 2 balls in front of them, split and steal. And in the exact same way of the prisoner's dilemma, if both of the parties choose split, then the money and the pot of money is split. If one party chooses steal and one chooses split, then the one who chooses steal gets all of the money. And if both parties choose steal, then neither of them get the money. And so most of the time it would be extremely predictable with one of them or both of them choosing the steal ball. Occasionally you would get 2 people splitting, but it wasn't the norm at all. And then there was one very interesting episode with Nick and Ibrahim, which we're actually going to watch now.
About what you both should do. Nick, Ibrahim.
Ibrahim, I want you to trust me. 100% I'm going to pick the steel ball.
Sorry, you're going to...
I'm going to choose the steel ball.
You're going to take
I want you to do split, and I promise you that I will split the money with you.
Well, after you've took steel?
Yeah.
You're going to take steel?
Yeah.
I'm going to take split?
Yeah.
So you take the money?
And I will split it with you.
After the show?
Yeah.
Do now have to push you for a decision. It's a tough one.
We've lost it. We've lost everything.
Okay. We've lost then.
We're walking away with no money because you're an idiot.
No, that's
You're
not
an
true.
idiot. You're an idiot. That's what you are. You're an idiot. You're an idiot. That's what you are.
This can go on all night, and these people have got to get up for breakfast. Nick, choose split or steal. Ibrahim, choose split or steal. Now, please. Choose a ball.
Right, I'll tell you what, I'm going to go with you.
Okay.
I'm going to go with
I promise you I will split it.
You cannot change your balls now. Split or steal? Yes! Congratulations, you're both split and each received £6,800.
And then this is actually an interview with Ibrahim, the guy who was forced to play the split ball from after the show. So we're going to listen to that now.
When we asked Ibrahim, like, if Nick hadn't deployed that crazy strategy, would you have still split? Because that's what you were saying to him the whole time, that you're going to split it. You're going to share the money. Would you have still done it?
No, not at all. Not at all. I was always going to steal. I was never going to split. Never.
Really?
Never. Really. I was never going to split.
Why?
But
why?
why? The reason being, if I split and the other guy steals, I get nothing. I'd rather both of us walk away with nothing than someone, embarrass me to a certain extent.
So as you can see from this, Nick in this situation basically beat the game theory. Nick made it so that Ibrahim's only solution was for him to split, because if he steals, then he's guaranteed 0, and if he splits, then there's a chance he gets 0 if Nick is being dishonest, but there's also a chance Nick is being honest and he gives him half of the money. So in that situation, the only solution was for Ibrahim to split. And what he's essentially doing here is no longer playing by the same rules of the game. He's actually changing the rules of the game. And this is essentially what Bitcoin did. Bitcoin changed the rules of the game. We no longer have to play by the rules of fiat. Bearing in mind that they have to print more, as per game theory, there is no situation where they do not debase the currency. So if you stay on fiat, you have to get poorer. You will get poorer. And so just as Ibrahim was forced to pick split, we are forced to get off fiat, because the most optimal solution for us is not to get poorer, obviously. So the only solution for us is to get off fiat. So whereas previously the Nash equilibrium of fiat and of the entire system, because there was no alternative to fiat, was to print and was to debase, the Nash equilibrium has now shifted away from fiat, and fiat is no longer the optimal solution. The optimal strategy is now to get out of fiat. So as you remember, we saw that price of a home in US dollars from 2016 to 2024 going up, but the price of that home is now actually reducing in terms of Bitcoin. You know, previously costing 664 Bitcoins and now only costing 6.6 Bitcoins. And on top of this, we are actually incentivized to borrow as many dollars as we possibly can and buy Bitcoin with those dollars, because the dollar is guaranteed to go down as per the incentives of fiat. And just as everyone who has done well buying hard assets with borrowed money over the past 40 years, likely that is going to happen if you do the same with Bitcoin, not financial advice. And so now we're going to have a look at some of the game theory and how Bitcoin really changed the incentives. So because of the popularity of Bitcoin, political parties are now essentially having to endorse Bitcoin and crypto. Trump has recently come out as very pro-crypto, and this basically has forced the Democrats' hand to become also, you know, tolerant of crypto. I wouldn't say they're pro-crypto, but they are now tolerant. The thing is, no one is going to vote against a pro-crypto candidate, even if you don't particularly care about crypto, but people will vote against an anti-crypto candidate. You know, that is a issue which could sway someone's vote, especially if you're deep into it. So whereas the incentives in a fiat world are to promise the world and promise, you know, prosperous times ahead, the incentives of the Bitcoin world is now to become pro-crypto, and that is now the most optimal solution for these parties. And it's very similar for Bitcoin mining. So if you remember back in 2021, China banned Bitcoin mining and it caused a huge dip in the hash rate. However, all that happened was that all of the mining then had to move abroad, which meant that China then lost out on all of the tax revenues and started to push the Bitcoin development abroad. And as you see, the hash rate recovered pretty quickly. And the same is true with nation states. So El Salvador fairly recently adopted Bitcoin as a reserve asset, and more than likely that is going to cause a chain reaction as other countries see how well the strategy is working out. And here we actually have a diagram of the choices that two nations can make. So option 1 is that both nations don't buy and central banking is unaffected. Option 2 is that one nation buys and the other doesn't. And then that nation that buys early and gets in early becomes richer, and the nation that doesn't adopt becomes poorer as a result. Or the third option, which is both nations adopt early, and that would potentially be giving up their monopoly on the money, but overall, because they're adopting early and getting a very scarce and very valuable asset, that is the Nash equilibrium, and that is the most optimal strategy. And it's a very similar story with corporations. So Michael Saylor has kind of made the playbook for this. Basically, you take out as much convertible debt in fiat and in dollars as possible, and you put it into the asset that is growing in adoption and growing in popularity. And by doing that, he is doing the same thing that all of those people who were able to buy a house 40 years ago and become incredibly wealthy with, but he is just buying Bitcoin instead. And as you can see, Bitcoin is outperforming every other traditional asset that exists. There is also a game theory to the proof-of-work mining, where miners are basically incentivized to be honest. Because if one miner is being dishonest and the other miner is being honest, then the honest miner is much more likely to get that reward. So the Bitcoin network compels miners to be honest, or their work will be rejected and their energy and money wasted. But it's very important to note that proof-of-stake does not have this same incentive structure. One of the most common arguments against proof-of-stake is that validators are incentivized to be honest as they are large holders of the token, and if they are dishonest, then that could devalue the token. But however, you have to remember that money is not the only form of power. Getting money is not the only way to win the game. And so if more power can be gained either politically or militarily, then damage to the reputation of the money is done, and financial loss, then the optimal strategy is not always to be honest as a validator, but the optimal strategy is to take the route that gives you the most political or military power. So the same incentive structures don't exist in a proof of stake system as a proof of work system. And now you're probably thinking, oh, why is he talking about Bitcoin? I thought this video was going to be about Kaspa. And we are going to get onto Kaspa, but it is important to understand that really Bitcoin changed the game. It allowed people an escape from fiat, and it changed the incentive structures and changed the Nash equilibrium. However, as we know, Bitcoin has that fatal flaw of scalability. So the previous is all true, and the incentive structures are there for Bitcoin adoption to continue happening and people to continue exiting the fiat system. However, it all relies on one thing, which is adoption to continue happening, which will then drive prices higher, which will cause more adoption. If adoption ever stops, then the whole thing will stop working, as the optimal strategy is no longer to adopt Bitcoin if the price stops going up. And because most people are too poor and will not be able to afford Bitcoin using the base layer, therefore, as Bitcoiners want this number go up technology to continue, that requires adoption. But most are too poor to adopt. Therefore, Bitcoiners are incentivized per game theory to try and push people onto the layer 2s and get people to use the layer 2s. So the Nash equilibrium of Bitcoin, the most optimal strategy to cause the most adoption and cause the most rise in prices, is to get people onto the layer 2s. And we can actually see that. A lot of the popular people within the Bitcoin space advocate more for layer 2s than they do for the base chain. So Bitcoin on-chain payments aren't for the merchant, they're for the central banks. You can have all the world's payment networks built on top of Bitcoin, only settling on-chain. Bitcoin is like central bank gold under a gold standard, and that's a quote by Saifedean Ammous, who's the author of the Bitcoin Standard. And there's also Lynn Alden, who says, using Bitcoin's base layer for $8 equivalent transactions is like using a screwdriver to hammer a nail in, and then complaining about the qualities of the screwdriver. The base layer is for larger settlements comparable to Fedwire or gold shipments. And so we're now actually going to watch a podcast of Michael Saylor talking about this.
The protocol doesn't have to do everything. You have to leave opportunity for functioning and scalability to the layer 2, to the layer 3s. And oftentimes the most aggressive protocols, they dismiss the role of corporations in this entire equation. Like the idea of be your own bank. It's like, well, everybody's just got to be their own bank. But I think at some point we're sacrificing the interests of sound money in pursuit of the ideal of sovereignty of the individual. And it's not clear to me that you get both, right? And certainly you don't get both at the same time.
So as you can see, basically the consensus among Bitcoiners now is that they will have to go to layer 2s and that the base layer will never be scalable. So now we are going to have a look at the incentives of Bitcoin layer 2s. Because in my opinion, layer 2s perverse the incentives, just as fiat gives perverse incentives. And so the reason for this is that layer 2s and layer 3s and any other layer other than the base layer fundamentally is a business. And as we know, businesses want customers, they want people to use their service. And so how can one business gain an advantage over another business? Or how can one Lightning channel or Bitcoin bank gain customers and gain business over another one? Because bearing in mind that these businesses have to pay fees on the base chain, and these fees they will have to pass over to their customers eventually. So one way that they will be able to lower fees is to create fractional reserve Bitcoin or paper Bitcoin and lend this paper Bitcoin out to other users and to other people in the exact same mechanism that banking and central banking did with gold, under the knowledge that at any one time, more than likely, everybody won't want their Bitcoin back at any one time. So they can lower their fees and increase their customer base and increase their amount of business by creating paper Bitcoin. So you have to understand this. The Nash equilibrium, the most optimal thing for these businesses to do, is to create paper Bitcoin and to lend Bitcoin out and create more claims on the Bitcoin than actually exists. And as we know from the Nash equilibrium, that is a result that will basically always play out given enough time. And this eventually will cause digital bank runs. And digital bank runs actually have their own game theory and equilibrium, because if no one ever had a run on the bank or tried to withdraw their asset from the bank, then bank runs would never happen. But because the one who runs the bank early benefits the most and gets the most amount of their collateral back, and the one who runs late to the bank loses out and loses all of their collateral, the incentives are set up for bank runs to happen because you're incentivized to try and be ahead of the curve and withdraw early. And so the Nash equilibrium of any fractionally reserved system is to try and get all of your collateral out at the cost of others. And so now we need to have a look at the incentives of someone who is too poor to use the Bitcoin base layer, which will be the vast majority of people. There will only be a handful of large corporations and large governments that are able to use the base layer. And so you hear the argument that 99% of people won't care about having their Bitcoin in self-custody. And my answer to that is they only won't care until they do. They are going to find out the hard way, not your keys, not your Bitcoin, and they will realize that the Bitcoin they thought they had a claim on doesn't actually exist and someone else has it. So what then is the incentives of these people who are forced to use the layer 2s, bearing in mind that the layer 2s are incentivized to create fractional Bitcoin? The incentive of these people is to no longer use the Bitcoin. They are incentivized to change chains because this is the most optimal strategy for those players. And previously, there hasn't been a chain that has reasonably fulfilled the role of money until now. Kaspa, once again, just like Bitcoin changed the rules of the game, Kaspa has changed the rules of the game, and people no longer have to play by the rules that will inevitably play out. Anyone who's paying attention understands that something different is going on with Kaspa. Kaspa is not just another altcoin. This is a movement of people and a network of people who are using Kaspa as their money. And so you can either wait for the perverse incentives of Bitcoin layer 2s to play out, which they inevitably will, or you can just front run it and anticipate what's actually going to happen in the future and swap chain before everybody else realizes that they need to swap chains, bearing in mind that the same effect is happening with Kaspa that was happening with Bitcoin, and that goods and services are getting cheaper to those who have adopted the Kaspa standard. And as far as we can tell, this trend is just going to continue. And really, you are incentivized to be early to this and to make the swap early. And really, you are incentivized to be able to recognize what is going on as early as possible, because those who swap early will be rewarded the most. And so there's this quote from Satoshi in 2009, "It might make sense just to get some in case it does catch on. If enough people think this way, that becomes a self-fulfilling prophecy." Once it gets bootstrapped, there are so many applications if you could effortlessly pay a few cents to a website as easily as dropping coins in a vending machine. And that quote is further evidence that Satoshi really did intend Bitcoin to be a peer-to-peer electronic cash system, not a custodian-to-custodian electronic cash system. And so, for a large holder of Bitcoin, is it better to try and stop Kaspa and to try and fight it? Or is it better to just de-risk and just get yourself a little bit of Kaspa? For the responsible investor, you obviously don't put your entire portfolio straight into it, but you get some just in case it does catch on, and just in case it does start eating market share of Bitcoin. And I really am a perfect example of this. I was a Bitcoin maxi because I understood that everything else out there that is attempting to solve the issue of money and become a better form of money was failing miserably, and that Bitcoin was the best solution. But then when I truly understood and researched what Kaspa was, I really only had one choice. I had to get myself off Bitcoin and onto Kaspa and de-risk and get at least a little bit of Kaspa. And me thinking this is not going to be a unique thing. I am a very typical actor within the markets, and so any Bitcoin maxi out there who truly understands Kaspa and who truly understands the game theory of everything is going to really only have one choice, and that is to protect their downside and de-risk by at least getting a little bit of Kaspa. And even if you don't own Bitcoin, then the risk reward of buying Kaspa at the minute is just insane. So this is going off the power law, and what the power law predicts the fair value of Kaspa will be. So the power law predicts a fair value of $1,000 in 2039. And so you have a game theory here of, you really have two options. You can either buy 1,366 Kaspa, or you don't buy that amount. And I've chosen that amount because that amount is the equivalent of one Bitcoin, and at the minute costs give or take $200. So you basically have two options here. If you don't buy, then if Kaspa fails, then you've effectively gained $200 because you prevented the loss of $200, so that could also be seen as a gain. But if Kaspa does succeed and truly does become the future money of humanity, and you don't buy it, then that will be a $1,365,000 loss of money that you could have had, but you didn't because you didn't buy it. And let's say you do buy 1,366 Kaspa and Kaspa does fail, then you've lost $200. But if you do buy 1,366 Kaspa and we do continue to follow the power law, then that is a gain of $1,365,000. And so really, when you look at the risk reward, the only optimal solution in this case is to buy the Kaspa just as a hedge to if it does become the money of humanity or not. Obviously, that is not financial advice. That is just kind of how I see the current game theory and risk reward of Kaspa. And this game theory plays out all throughout Kaspa as well. You know, you hear a lot of people on X saying, oh, Kaspa needs a tier 1 exchange listing, and I argue the opposite. Kaspa doesn't need a tier 1 exchange. Exchanges need Kaspa. You know, when there is an idea as big as Kaspa and the trilemma solver, a tier 1 exchange would be taking a huge risk by not listing it. They would risk losing their market share. And so, for example, if Binance doesn't list Kaspa, even though I think they already have their position and I think they're going to list it at least this year, then I think KuCoin would basically overtake Binance in trading volume and they would lose their market share. Whereas Binance can de-risk and just buy some Kaspa with the idea of listing it, you know, not saying they have to go all in, but they just get at least some, then that is the optimal solution for Binance. And this will also occur with asset allocation and asset managers. You know, at the minute, what would be an appropriate allocation for an asset manager to put into Kaspa? You know, it would be an extremely small amount, you know, less than 0.1%. But as Kaspa grows, the risk inherently goes down. And so the allocation will grow higher of what they will want to put into Kaspa. And that in turn will create a positive feedback loop where, because it's less risky, they are willing to put more money in, and that drives the price higher, inherently making it less risky. And bearing in mind, if this does start playing out, it will likely be outperforming, you know, most other assets out there. And so, you know, this is the virtuous cycle that Bitcoiners want Bitcoin to continue going on. They want Bitcoin adoption to grow, and then Bitcoin becomes more valuable and better, and price goes up, and then a sort of virtuous cycle. But if Bitcoin can't get the adoption because people can't afford to use it, then the adoption of Bitcoin will slow, the network will get weaker, and the price will go up slower, which will then cause less adoption. Whereas Kaspa, when the adoption grows, Kaspa will get scarcer and better, and the price will go up, which will drive more adoption. So it is a virtuous cycle for Kaspa. And, you know, there is also the game theory of network effect. Adopters are incentivized to tell other people about Kaspa. And once those people truly understand what's going on, they are also incentivized to adopt, and then in turn are incentivized to tell other people about Kaspa, and that becomes a positive feedback loop. So this is a map of all the places in Europe and the Middle East that take Kaspa at the minute. I predict in, you know, 2 or 3 years' time, this will be a much, much higher number of places that take Kaspa as a form of payment. And the exact same mechanism happens when one country adopts Kaspa, whereby the country that adopts earlier and adopts first will become richer, and the country that adopts late will become poorer. And that means that countries are incentivized to adopt it earlier. So my prediction that I'm putting out, within 10 years, one sovereign nation will have adopted Kaspa as legal tender. What that will cause is a flood of capital to enter that country, which will then force other countries to pivot to try and retain that money and that capital staying within the country. You know, Kaspa is an alien asset. It has both a higher growth rate and a lower risk, which is a total drawdown, than Bitcoin. And people will argue that Kaspa has not really yet seen a bear market, which is true, but I have reason to believe that this pattern will continue into the future. And if this does really continue, then asset managers are going to absolutely love Kaspa, because not only does it have higher compounded annual growth rate, but it also has a lower risk and a lower drawdown, which is exactly what asset managers want. So fundamentally, the game theory incentives of Kaspa are the exact same as those of Bitcoin. However, there will be no push to go to the layer 2s on Kaspa because it is scalable, and therefore adoption can occur indefinitely on Kaspa without ever perverting the incentives, like the incentives of the layer 2s become perverted. And so you can either wait for the perverse incentives of Bitcoin to emerge, or you can anticipate these and position yourself on the chain that represents the best strategy to adopt. So Kaspa is the Nash equilibrium. Kaspa is the monetary technology that gives the highest number of people the greatest advantage to adopt. And as per game theory, and as per the rational actors, more and more people are starting to realise this, and more people are starting to swap over, and that, I believe, is only going to grow because of the network effects, and because of the incentives, and because of the game theory of Kaspa. So thank you very much, you guys, for watching. Don't forget to like and subscribe, and also follow me on X if you're not following me on over there. But other than that, thanks for watching, and until next time, cheers.